Hi, so in this video we're going to cover the consequences of inflation, which can be of course horrendous and significant if we're talking about hyperinflation, but here we're talking about moderate inflation. So I'll try and do the most important ones we can't do anything about. If inflation is expected and anticipated, then governments can compensate for it. We'll come to that. But to start with, you've got high inflation in one country. It's going to make your goods and indeed services less competitive internationally. So if you've got a higher rate of inflation in, say, Britain compared to Germany, then over time our goods are going to become less competitive and they're going to become less price competitive. So therefore there's going to be fewer exports, there's going to be more imports because they're of course becoming relatively cheaper, and therefore the balance of payments current account will worsen. However, if their inflation is increasing at a similar rate to our inflation, there's not a problem. Say there's 4% inflation in Britain, there's 4% inflation for our main competitors, then there's not going to be a difference really in price competitiveness because of inflation. There might be other factors, of course. However, if our inflation is higher, then it's going to erode our international price competitiveness. However, we could have an adjustment where there's a depreciation or devaluation of the pound, of the exchange rate, and that will compensate because it will make our exports cheaper. However, if you do that, imports, if you depreciate the currency, imports are going to become more expensive. And that could cause more cost-push inflation, of course. And of course, it will worsen the terms of trade. Look at the video on terms of trade for that. So a big issue is, over time, and not in the short run, but more in the long run, it could adversely affect Britain or a country's international competitiveness. Now, another big issue to do with inflation that is hard to adjust for is it erodes the functioning of the market mechanism. Now, it needs to be at a reasonable rate to do this. 2% inflation, 4% inflation probably won't do that, but the market mechanism is a way of achieving additive efficiency, where the price mechanism, the price signal, allocates demand and supply. Now, if you have inflation noise, which is rising prices, but some rising more than others, and an element of randomness to these price rises, and the higher the rate of inflation, the more unpredictable the price changes, and the more that the rate of inflation actually varies around the average, then this is going to create a lot of inflationary noise, and it'll erode the price signals as part of the market mechanism. They become distorted, and therefore it reduces the efficiency of market allocation. So this is potentially a serious concern if inflation reaches high levels. And this is really linked to consumer and business behaviour, because as you have high rates of inflation, firms, businesses have quite an increasing degree of uncertainty, because about prices, profits and costs. Prices, profits and costs become increasingly unpredictable at higher rates of inflation. So it can have a harmful effect on business investment and business confidence. And it can have a harmful effect on consumer certainty, because similarly, with higher prices and more variability, then consumers become more uncertain. As I was trying to give you an example of this and explain how it impedes the price signal. If you look at, say, Coca-Cola, you know how much to pay for a can of Coca-Cola, don't you? So you know if it's £2 for a can of Coca-Cola, you know you're kind of being ripped off. whereas it's 50p, you think, oh, that's quite good value. Now the thing is, over time, if you've got quite high inflation, you won't know in your head, you know, what price should you pay for a Coca-Cola, and that's reducing your consumer sovereignty and your consumer power, and it's impaling the price mechanism. Okay, so to argue against what I've just said, low levels of inflation do encourage consumption because it's better to buy now than to buy in the future, and so it's worth bearing that in mind. And so low levels of inflation tend to encourage consumption and discourage saving, whereas of course deflation does the opposite. Okay, so now we'll look at two costs, shoe leather costs and menu costs. I'll put these on the side. You could argue they're relatively insignificant, but what are shoe leather costs? Well, traditionally, old school, the hassle, the inconvenience and the opportunity cost of having to go to the bank to move your cash from cash into a bank account, yeah? And yeah, there we go, it's £5 here, a bit of cash, not very much. So taking this and going to the bank and putting it into a high interest bearing account so that this isn't eroded in value by inflation. Now obviously this is not really a problem because you just get your phone out, you know, and you just transfer it on your phone, your iPad, your digital device, okay? I was looking for my phone, but I'm actually talking to it. All right. So you can see with technology, shoe leather costs aren't so much of a problem, although it's slightly inconvenient, time-consuming to move your assets around so that they don't suffer from inflation. We'll come back to that. But technology kind of probably solves the problem of shoe leather costs. Menu costs are where, I suppose, businesses have to change the prices of their goods that are displayed, and they have to do this and update them more rapidly, more quickly, more often rather, if there's inflation or high inflation. Obviously with IT and electronic pricing, this is not really a problem. So I'd argue that these two are relatively insignificant. However, when you're talking about hyperinflation, that is not necessarily the case. So let's come on to real incomes. Now, if your real income falls, you're going to suffer from inflation. Real income is simply your money or nominal income minus the inflation rate. So I'll give you an example. Say you get an increase in your income by 1%, okay? But the prevailing rate of inflation is 4%, okay? Means that your real income is going to fall, of course, by minus 3%, okay? Now, whose real income is going to fall? If you're a worker and you have weak negotiating power, so you don't have a strong trade union, you don't have a strong professional association, then if your incomes are going up 1%, 2%, the inflation's 4%, you're going to be falling behind in real terms, in terms of purchasing power. Because what inflation does is erodes the purchasing power of money and it increases the cost of living. Okay, obviously affects some people more differently to others, depending on what they buy, their basket of goods and services. Anyhow, a key thing is workers with weak negotiating power will lose out. Similarly, people on fixed money or nominal incomes, such as if you're a pensioner and you receive a state pension, which is a fixed amount, or you receive a pension privately, which is a fixed amount, then in real terms, that is going to become less. It's going to be eroded as the cost of living rises. So an example might be bondholders. If you're a bondholder with a fixed payment on your bond, you're going to lose out because of inflation. Some bonds and some assets are protected against this. However, it can be solved. So pensions can be index linked. This is the crucial word, index linked. If your salary, if your pension is index linked, it means it increases in line with inflation. and indeed the state pension in the UK is index linked, for example. So real income's a crucial point. And of course people often suffer from money illusion. So even quite bright people don't realise that in real terms their income is falling if the rate of inflation is higher than their nominal pay increase on their wages. Okay, coming to fiscal, obviously this can be dealt with quite easily by indexation, not necessarily a problem. Fiscal drag and fiscal boost, what is this? Well, this is really part of fiscal policy. There's a video on that. But just to go over it again, basically, if your income increases with inflation, so that your real income stays constant, so say inflation is 10%, your income increases 10%, fine, that's all okay. But the problem is, if there's a higher rate tax bracket, say at £50,000 you have to pay a higher rate of tax, more and more people are going to pay that higher rate of tax. So, for example, under New Labour, from 97 to 2010, instead of 1 million people paying the higher rate of tax of 40%, over 4 million people paid it. So it went up fourfold, and that's because of what the Americans call bracket creep. You creep into higher tax brackets, and therefore you pay more of your income in tax. It's generally known as fiscal drag. Okay, what a drag. It can be stopped very easily, can't it? Because all the government needs to do is index the tax allowance and the tax threshold. Okay, now fiscal boost, that sounds better. So imagine a bottle of alcohol, say a bottle of vodka, say it costs £10, and on that you've got £6 duty. Okay, £6 duty going to the government. So that is an excise tax, a specific expenditure tax. Okay, over time what's going to happen? Well, say the bottle goes up to £12. You're still only paying £6. So therefore you're paying less tax. Here you're paying more tax with fiscal drag. Here you're paying less tax to the government, okay? And this has particularly happened in Britain with fuel duty between, I think, 2010 and 2021, for example. It hasn't been increased. So that the real value of fuel duty has fallen. Not too environmental, you might say. So again, the government can easily adjust to this, and it generally does in the budget, because it increases the duty on, usually increases the duty on cigarettes, on alcohol, but not necessarily on fuel, but it could do by the rate of inflation, and in which case it would index the duty. Okay, so again, not a problem. So we can deal with this. Let's come on to the final part, which is redistribution, really between borrowers and savers. So basically borrowers gain, savers lose. The reason is if the real interest rate becomes negative, this is the crucial point. If the rate of inflation is greater than your interest rate, then you're going to suffer as a saver, but gain as a borrower, of course, because the cost of servicing your loan will fall. And indeed, the total amount of debt that you have will be eroded by inflation. If you have £100, say you have 1,000 marks debt in 1922, but after a year, it will become virtually nothing because of hyperinflation, of course. So the value, that's a Deutschmark, okay. The value of the debt falls in real terms. So the national debt, a good way governments can deal with the national debt is inflating it down, basically. A bit of inflation means it's falling over time. Who pays for this? Bondholders. So if you have high rates of inflation, people become a bit more cautious about buying bonds because they're eroded by the rate of inflation, in which case to get people to buy your bonds, you're going to have to offer a higher interest or better terms. Okay, if you're wealthy, you're quite likely to have less liquid assets, that's less like cash, and you might have shares, for example, in Apple, and they represent a pretty good protection against inflation, okay? Whereas if you're poor, you're likely to have less liquid assets, such as you might have a lot of cash lying around or cash in your current account. I have far too much cash in my current account, never mind. And that means you're less protected against inflation, silly me, okay? So, looking at the whole picture, if you have a low rate of inflation and it's in line with your main competitors, it probably encourages consumption and it doesn't distort market forces because we're talking about 2, 3, 4% creeping inflation, yeah, then you're not going to lose competitiveness because it's the same in other countries. It's not a problem. But high rates of inflation can be a problem, and indeed you can get second round effects where you get an increase in inflationary expectations, which leads to faster rates of inflation, and it soon takes off upwards. Bad news. So for example, if there was a world increase in oil prices, there was an inflationary spike, it wouldn't be a problem necessarily because it might be the same for our competitors and for us, okay? We could live with that for a few years as long as we get it back down to lower levels. Okay, so thank you for watching. I hope that was useful. Take care.